The top business stories live from the Sky News City studio. Sharp fall in UK inflation as it drops below 4% for the first time in more than 2 years. The Financial Conduct Authority is to shake up the UK's listing rules to encourage more international businesses to list here. And the Danish company Ørsted says it will go ahead with developing the world's largest offshore wind farm in the British North Sea. Good afternoon, this is Business Live with me, Ian King. The Financial Conduct Authority has today proposed shaking up the UK's listing rules in an attempt to stem the flow of companies moving their listing from the UK to elsewhere. Those who have gone in recent years include BHP, the miner, which was previously the biggest company on the FTSE 100, and CRH, the owner of Tarmac. The proposals include scrapping the distinction between London's premium and standard listing segments and removing a need for shareholders to approve some large transactions or those with so-called related parties. Well, earlier, Sarah Pritchard, the FCA's Executive Director of Markets, explained the watchdog's thinking.
One of the key changes here is a move away from shareholder votes in advance of big transactions and related party transactions to a philosophy that's disclosure-based. But crucially, we're looking to make sure that the right information is in the hands of investors so that investors can make their own decisions on companies to invest in and hold companies to account. As we've said, we want to make sure that we have the balance right. This is a rebalancing of risk, which is why we want a public consultation and engagement on it.
Well, joining me now is James Wootton, partner and co-head of global equities at the global law firm Linklaters. James, afternoon to you. Afternoon. Is this going to stem the flow of departures, do you think?
It's certainly part of a package that will reinvigorate London's equity markets. The forces that London and the equity markets of the world generally have been facing are in many ways out of the control of the regulator, but this is absolutely a bold and really important start.
A lot of people seem to think this is going to represent a watering down of the UK's corporate governance standards. What do you think?
I don't see it as that. The FCA has been absolutely assiduous in its approach in the consultation it's been through already. And really what we're seeing is a slightly different approach to risk-taking, an acknowledgement that you have to take a bit more risk potentially to get a bit more reward. So with every risk is an opportunity. And certainly a lot of people on many sections of the city, the investment and the company community have been crying out for a little bit more flexibility, a little bit more empowerment to take companies in the direction they want to go in.
And yet the FCA, by its own admission, says that there is an increased risk of corporate failures if these changes go through.
That may be the case, and the FCA has said that, but there's also always a risk of doing nothing. And the risk that's been identified over the last few years, as exemplified by companies leaving London or looking to list elsewhere, is that there's a risk to shareholders of companies being unable to grow in the way that they would like to, and there's a risk to London of companies choosing to list elsewhere. So absolutely we're addressing risk, and the question is how we approach it, and that's what the FCA is looking to do now.
And that's, in your view, the greater risk is actually the UK market becomes less competitive because we're deprived of better companies going elsewhere?
Well, I think the truth is for so long we've had London's been so powerful as a financial centre, but increasingly we've all become aware that we're in a global competition to retain that. So yes, absolutely there's a risk of assuming that London's preeminence will just continue. And so to ensure constantly that our rules should be refined to be fit for purpose, to optimise our competitiveness, that's absolutely crucial, yes.
Apart from changing the listing rules, what else could be done to give the equities market here a shot in the arm?
As I say, changing the listing rules is one part of it. Nobody, I believe, thinks this is the answer to everything. But it does send an important message that London, the regulators, the exchanges and the governments are listening to what the investment in the company, the advisory community say is the right thing to do. Are there other areas? Of course. There's work to be done on pension reform, on increasing retail participation in equity markets. There are things that could be done with tax and general cultural approach to risk-taking. But those are all absolutely still on the agenda and will form other pieces of this really important puzzle.
OK, James, we have to leave it there, I'm afraid. Good to see you this afternoon. Thank you.
Very much.
Some other business news stories for you now. And the annual rate of UK inflation has unexpectedly fallen to its lowest level for more than 2 years. The Office for National Statistics says that prices rose by 3.9% in the year to November. That was down from 4.6% in October and significantly lower than the 4.4% that had been expected. The ONS said the biggest driver for the fall was a decrease in fuel prices after an increase at the same time last year. Food prices also rose much more slowly than they did this time last year. It's the lowest inflation figure since September 2021 and will raise hopes that the Bank of England's Monetary Policy Committee may cut interest rates next year earlier than previously expected. Core inflation, which strips out volatile elements like food, energy, alcohol and tobacco, and which is closely watched by the MPC, fell from 5.7% to 5.1%. The Danish offshore wind developer Ørsted said today it will go ahead with developing the world's largest offshore wind farm in the British North Sea. Hornsea 3, located 160 kilometres off the Yorkshire coast, will have a capacity of 2.9 gigawatts, producing enough low-cost renewable energy to power more than 3.3 million UK homes. Ørsted, which currently operates 12 offshore wind farms in the UK, said Hornsea 3 would support up to 5,000 jobs during its construction phase, with a further 1,200 permanent jobs, both directly and in the supply chain. Now, when banks talk about incorporating AI into what they do, it's usually on the operational side rather than seeking to improve the experience of their customers. Well, now Bunk, the second largest digital bank in Europe, is claiming to have become the continent's first AI-powered bank. It's launched a Gen AI-driven platform called Fin, which will be available to all of its 11 million users. Well, joining me now to talk about this is Ali Nicknam. He's the chief executive of Bunk. Ali, good to see you this afternoon. So what is specifically on offer here to customers?
As you correctly said, is that usually when we talk about AI, it's about the obvious things and cost saving and a little bit of the boring stuff. But what we have turned it into something that actually benefits our 11 million users. Thanks to the power of generative AI, we call our bot Fin, you're able to ask questions like, what's my favorite pizza place nearby? Or what's the place I visited with my friends last year when we were here? So it actually enhances your experience and it helps you make life easy in your everyday decisions.
How worried are you that the competition will start developing something like this? You're up against some big beasts.
Yes, we are, but we love a good and healthy competition.
OK. Is there anything that this platform can't do just now, which you'd like it to do in future?
Well, it's a very early model, so we'd like to ask everyone to use it and give us feedback so we can make it better and better. But we expect a lot of improvements in 2024.
Now, more broadly, you stopped offering accounts in the UK in 2020. I gather you're coming back.
Yes, we're doing our best. The UK has always been a very important market to us. We love our British users. We still have them on our platform. We just haven't been able to accept new users due to all the regulatory hassle post-Brexit. Now, we have been working very hard in finding a way to make it feasible for us to continue offering to new users our services, and we hope to have a breakthrough several months down the line.
All right, Ali, we're really pushed for time today, I'm afraid. I do apologise. We're going to have to end it there. Thanks for joining me today. Good to see you.
Thank you for having me.
Still to come here on Business Live. We'll be telling you how the markets have finished this afternoon. Don't go away.
They've pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'll have nowhere to live for
about 3 or 4 months.
There are still people inside the properties here.
They are coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight.
What's your feeling about the future then?
Blake might all be finished, I don't know.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, the pound fell sharply on the lower than expected inflation figure this morning, while gilt yields also fell as investors began to price in an earlier Bank of England rate cut than previously expected. Sterling currently off 0.5% against the US dollar, off 1/3 against the euro, the single currency off nearly 1/4% against the dollar. On the equity markets, this is how Europe has finished the session. All pretty mixed, right? In fact, only the CAC are in positive territory after the closing auctions. Talking points this afternoon include Telecom Italia, which is up 5.5% after the Spanish government announced plans to take a 10% stake in its peer Telefonica. Well, here in London, the FTSE 100 has finished in positive territory, again on the back of the Bank of England rate cut, up a full percentage point. That is the highest finish for the FTSE since the 24th of May, and that is on the back of the benign inflation data. Obviously, property and consumer-facing stocks all among the leading gainers right now, among leading blue-chip gainers at the close. Marks and Spencer up 2.5%, Kingfisher up by a similar amount, and Land Securities also ahead. The top gainer in percentage terms, though, is the quality assurance services provider Intertek. That finished up nearly 3.75%, and that was on the back of supportive broker comment. It's a similar story outside the FTSE 100. Property stocks all doing well. Great Portland Estates was the top mid-cap gainer, up 5.75%. Derwent London was not far behind, up 3%. Over on Wall Street, the S&P 500 has taken a bit of a breather after a strong run. The Nasdaq in positive territory just now. Talking points this afternoon include FedEx. It's fallen by 10.25% after it cut its full-year sales forecast, while the e-scooter and e-bike rental provider Bird has slumped 78%, and that is after it filed for Chapter 11 bankruptcy protection. The oil price, meanwhile, has continued to grind higher on the situation in the Red Sea. Barrel of Brent crude currently changing hands at $80.08 a barrel. That's up 1%. That is the first time it's been back above $80 a barrel since the 1st of December. Well, joining me now is great great friend of the programme, Bill Dinning, Chief Investment Officer of Waverton Investment Management. Bill, good to see you this afternoon. Obviously, the inflation number is the big talking point today. Rate expectations have really repriced today. Is the market getting ahead of itself?
Well, I think it probably is, and I think that's probably true on both sides of the Atlantic. I mean, in the middle of October, you know, there was sort of a rate cut probably in the UK. We've now got 3 or 4, and in the States we've got more than that. And it'll be interesting to see how policymakers push back on that, because there's been a little bit of pushback from Fed officials after last week. But I think that the genie's a little bit out of the bottle here. I suspect they're probably, the jawboning the market probably isn't going to work. I think the real question is going to be, does inflation stop improving so rapidly? Things like core services inflation is still pretty high on both sides of the Atlantic. Some of this supply issues around, if it takes 2 extra weeks to get a container ship around Africa rather than going through the Red Sea, there's a possibility that some of the good news about inflation that might be peaking. So I think it probably is a bit ahead of itself.
Very interesting to see the move in some of these consumer-facing stocks this afternoon, though. I mean, you've got wage inflation now running at more than twice nearly the headline rate of inflation.
Yeah, and I think, you know, the consumer resilience has been a theme, again, I think, on both sides of the Atlantic. I think from the policymakers' point of view, they desperately need the good inflation story to continue, because I think this year has really been about that inflation picture improving. And here in the UK, it's only really improved perhaps in the last 3 months or so, when in the summer we were worried that UK inflation wasn't coming down as quickly as it was in Europe or in the US. Well, that's now no longer the case. We need that to continue happening. And the other thing that's happened is this sort of persistence of stronger growth, particularly in the United States, which has caught some of us by surprise. So that combination of lower than expected inflation, higher than expected growth, particularly in the States, has obviously been very supportive in the end for the stock market, and indeed for the stock market more broadly in the last few weeks, having been very concentrated earlier in the year.
Yeah, I mean, the market is now pricing in a first rate cut from the bank in May next year. Is that likely?
It's certainly possible, because I think if the inflation picture continues to improve, that may well reflect also the fact that some of that demand strength that we've just talked about maybe starts to dissipate a little bit. Because the thing that has, I think, confused particularly perhaps people who started out as economists in this industry many decades ago, like me, has been that some of the most reliable cyclical indicators of the economy have been flashing red warning signals. The yield curve inverted at 10-year to 3-month last October, so that's nearly 14 months ago. And so many other indicators have suggested that. And clearly, so far, this cycle has proved to be different. But one does wonder whether or not actually we do start to see a bit more signs of a slowdown. If that happens, then at least the central banks can respond. But the equity market response at the moment is all about, well, they're cutting rates, and I think earnings expectations are plus 11.5 in the States for next year, and they're going to be cutting rates. Well, wow. Well, I think they're probably only going to be able to meet any of those rate cut expectations if, in fact, not only is inflation benign, but actually we see more of a signs of a slowdown in the economy. And that wouldn't be as good for the equity market.
All right, Bill, always good to see you. Thanks for joining me this afternoon. I know you've had a really busy day, so it's good to see you.
Thank you very much.
Thank you. That's it from me. I'm back again tomorrow morning at 11:30 with our next edition of Business Live. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's the News Hour with Mark Austin. Cheerio.